Well, that was fun for about 30 minutes. Live from New York City this morning. Good morning, good morning. Your equity market just a touch lower on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, the U.S. payrolls report coming in hot with the latest read on inflation coming up next. Chairman Powell's next move, less than a week away. We begin with the big issue, payrolls in America.
Look at the jobs report, non-farm payrolls. It's important.
That's really what we're going to be focused on.
Every piece of economic information gives you evidence about what's happening.
Jobs market now is coming into question in terms of how resilient it really is.
We still have more and more evidence pointing in the direction of the labor market softening.
It's not weak, but it's no longer as robust as it was.
We are normalizing. The labor market is hanging in there. The economy is hanging in there.
The general story we have is economy that's slowing.
In order to get a Fed cut.
In order for central banks to really feel confident that inflation is more sustainably at their target.
You've got to see some meaningful degradation in the labor market.
You need to see a little bit more loosening of the labor market.
Go back to the labor market.
All roads point to labor.
And breathe. Joining us now to discuss, Mohammed Al-Erin of Queen's College, Cambridge, BlackRock's Rick Reeder. Gents, always great to do this with you both. Mohammed, what was that?
That was good news for the economy and further confirmation that the U.S. has an exceptional labor market and an exceptional economy. You saw significant wage growth this late in the cycle, significant job growth, higher wage growth, and high labor force participation. And I don't think the fixed income market would have sold off this much had it not rallied excessively in the last few weeks. So bottom line, John, this is good news for the economy, and the market has to think very carefully about the amounts of cuts it is pricing in for next year.
Rick Reeder, where did this come from?
So I'd say a couple of things we talk about on the show all the time. You have a different economy than you've had in the past. We had 99,000 jobs in healthcare and education out of 199,000 jobs. So what you got to parse the data. And, you don't have this standard cyclical economy. You have a service-oriented economy where we're still hiring a lot of nurses and teachers, and it manifested itself again today. That is the one going forward that I think it's going to be worth focusing on. Part of why I don't really believe in this soft landing, hard landing. I just think in a service economy, you're just driving to a slower economy, but nothing that bad. One other point that I would say, and touching on what Mohammed said, you have a lot of people that are joining the workforce as well. Another 500,000 people come into the labor force. So I think there's something that's important here. You are building the dynamic around more people coming into the labor force. You saw the JOLTS report, some hiring coming down. So you're building slack, but really, really slowly. And again, it's an environment where the Fed can sit back, wait, and then I think the latter part of the year they can start cutting rates. But as Mohammed said, markets were a little overzealous. They were pricing in a March, more than a 65% chance of a March cut. That seems overdone, to say the least.
Mohammed, let's build on that. The difference right now between where the market is and where the Fed is and what they're trying to communicate.
Yeah, it's striking. We've seen this already last year when the market expected rate cuts this year, didn't get them, and the market rushed again and priced in early and significant rate cuts. Look, the Fed is not happy with the loosening of financial condition that has happened in November and early December, and it's been a massive loosening of financial conditions. And what this report confirms is not only that we have a solid labor market, but also, as Rick rightly said, keep an eye on the service sector, because in order to get to 2% inflation, you need goods deflation to continue, and you need service disinflation to accelerate. And I don't think we're going to see the service disinflation accelerating with what's happening in that sector. The bottom line, John, is back to the Fed is really unlikely to start cutting in March, as markets were expecting. I mean, now I think the latest now implied probability is about 47.5% for March. That's still too high.
If that's the bottom line, here's the headline. 199 in the payrolls report, an upside surprise. Unemployment down to 3.7% and wages looking decent. Mike McKee's got the details. Morning, Mike.
Good morning, John. Well, the Labor Department seems to have had a problem with its release, but we have all the numbers right now, and it is 199,000, as you say. Interesting thing, revisions, negative 35,000, and that is all to September. October was unchanged at 150,000. Manufacturing jobs up by 28,000. We'd lost 35,000. That's a return of the United Auto Workers. So subtract that out and you get 171,000, which is still strong job growth for the month. The unemployment number is the stunner for the month, 3.7%, as more than 700,000 people enter the labor force, more than 500,000 of them new entrants, not moving over from unemployment to employment, but coming into the labor force. And that's going to be greeted with huzzas down at the White House. Average hourly earnings, up 4% on the year, and on a 3-month annual basis, up at 3.4%. It had been 3.7 in October. So we're seeing wage growth slow at a time when we're still seeing a lot of jobs out there. Where are the jobs? Healthcare, as always, 77,000 basically, and government 49,000. Interesting thing here for those on the campaign trail, these were all state and local jobs. It wasn't an expansion of the federal government. Leisure and hospitality up 40,000. Most of those restaurants, maybe some department store Santas, except that retail hiring was down by 38,000, and almost all that comes out of department stores. So not clear what's going on there. Coming into this, there had been talk that the SOM rule would be triggered, that when unemployment rises by a certain amount off its lows, that you're in recession. We're not in recession, I think, is the easy way to sum that up right now, John.
Just had 5% plus GDP growth in the third quarter, Mike, and we've just got unemployment down to 3.7%. Mike McKee, thank you. Plenty of takes rolling in. Here's one from Neil Dutta of Renaissance Macro. The labour market is not the primary driver for monetary policy right now. He goes on to say, indeed, there is an asymmetry in the Fed's policy reaction function. Stronger employment will not push them away from a cut as much as weaker inflation will push them towards one. Rick, I'd love your thoughts on that quote right there. Is this labour market no longer a reason to be hawkish?
So I actually think it's right. So there's a couple of things at play here. Does the Fed have to cut quickly because of a real slowdown in employment? Clearly not. We've ruled that out. But there is something, and Mohammed said it. So let's break down inflation. If you take service level inflation, it's running at 3.5. That's down from 8. So the momentum is good. Goods inflation is actually deflating moderately, but it's service level inflation you have to bring down. My sense is that will come down, but it'll come down very slowly. So what does the Fed do? So now take the funds rate. You've got a funds rate at let's say 5 3/8. If you've got inflation, if you've got core PCE, core CPI next year, that's going to get down to 2.5. And we think that's about where we're going. That's a Fed projection. That's about our projection. So you've got a funds rate at 5 3/8. You've got inflation running at 2.5. You've got real rates that are way too high. So you've got to cut rates, I think, 100 basis points to get to what is, quite frankly, a somewhat restrictive level. And I think that's what's going to happen. But it has to be instigated by that service level inflation. As Mohammed said, you're just not going to get core goods that deflate that much. You've got to see some moderation in service level inflation. My sense is you'll get that. But it's slow. By the way, things like shelter come with a lag, so you think that would slow. But there's some sticky things: medical supply, healthcare insurance, auto insurance. Some of those things are just sticky, and they're not cyclical, and it's hard for the Fed to influence them.
Well, let's get to the Federal Reserve, Mohammed. Next week, 3-part act: statement, news conference, projections. What are you expecting next week?
So I think they're going to repeat, because they're going to try and push back against the loosening of financial conditions. So they're going to repeat what we heard from Chair Powell on Friday, which had 2 parts. It's premature to talk about rate cuts, and we may still need another hike. I don't think they'll believe the second bit, but they'll need to see it. I think in terms of what they project for next year, I am where Rick is, probably more like 100 basis points of cut than the 250 that the market has. And although they will not tell us that, it's more likely to come in the second half of the year than in the first half of the year. So that is what I'm looking for and expecting from this Fed. it'd be interesting to see how the market reacts. The market, as you know, has had very selective hearing. And it was stunning to me that last Friday, when Chair Powell tried to push back against what had been the massive loosening of financial conditions, he basically got sidearmed, or I think you called it steamrolled, is the phrase you used that day, by yields coming down 10 basis points, despite what he said. So it's going to be interesting to see how closely the market listens to the Fed. But the market right now is totally ignoring Fed forward policy guidance.
I'm pleased you brought that up, Mohammed. Rick, let's talk about it. Mohammed's right. Chairman Powell got absolutely steamrolled. If that was pushback, this bond market looked right through it and laughed. Is Wednesday going to be any different?
So, I mean, so with a couple of, by the way, we also get a CPI report that's probably not going to be that soft. So, listen. So, no, I don't think Chairman Powell will be very different. But so let's break down the parts of the yield curve, because I think it's worth describing this. The very front end of the yield curve. We've been on the show many times talking about buy the front end, buy the front end, buy the front end. This month, it was time to sell the front end. The front end got crazy overdone. There's something that's really important, though, and it's something that I'm really going to be focused on. If you take the long-term Fed funds rate and you assume that it's going to be 2.5, maybe a little bit higher than that, the one thing that I think you can start doing now is I think you can start buying to the belly of the, we talked about it this month, and I think in your show and others, you can start buying out to the belly of the yield curve, because the forwards are now pricing in a level that is not there where the long-term funds rate is. So I think, quite frankly, you can be more comfortable today. Forget the front end, other than some cash management, obviously. But I think the belly of the curve, if he gets a nice, hopefully get a backup here. And, I think the forwards are interesting. And I think you can now hold some interest rate exposure, because I think we're done on hikes. And now we can start thinking about longer term cuts. And that's where you can get paid for it out more a bit further out the yield curve.
When you speak to people, are you seeing appetite to do just that, Rick? When you say the belly, we're talking about what, 5, 7s coming out of front end? Is that happening?
Definitely. So 3 to 7 year part of the curve, and 100%. And you've seen some of the flows. By the way, you saw some flows, significant flows on the back end of the curve. That's pension, et cetera, that was driving the back end to pretty aggressive levels. But that is, I would argue, largely non-economic, defeasing or locking in your funding against your liabilities. But yeah, there is definitely some. I think as you get into 2024, people are going to get more comfortable with inflation, the persistence of a stable to lower inflation, and more of that are people are going to say, you know what, I want to lock these yields in because we're at pretty good yields. If we're getting to, so let's say economy GDP runs at 1.5-ish or maybe a little lower next year, and you get 2.5 inflation. These yield levels for, you can buy quality assets, quality yield at 6%, 6.5. People are going to have started and are going to start locking that in.
Mohammed, final word. Do you agree?
I do. I think the harder call, and you should give the final word to Rick, the harder call is what do you do with U.S. credit, where spreads have really compressed. And a lot of people are hoping that they would get both the yields and the spread benefits to their bottom line, and both things have come down significantly. So I think the harder call right now is what do you do with U.S. high yield, for example. Rick?
That's too hard a question. So I said a couple of things. I think Mohammed's right. I think spreads, particularly in high yield with an economy slowing, it's just okay. Investment grade credit, though, and I completely agree, the spreads aren't that sexy. But because you think about what happened when rates were at zero, all these companies termed their debt out, including European IG, which I think is pretty darn attractive because of the cross-currency basis. But they termed their debt out. So now they don't have a maturity wall, and you're buying because the risk-free rate is so high. You're able to buy things like European credit as a dollar investor at 6% investment grade credit. So I totally agree on spreads, but for higher quality credit that you're not really worried about a default cycle, I think the yields are okay, and or not okay. I think the yields are attractive, and I think a year or two from now, people will say, "Gosh, that's a pretty good way to finance companies if you go buy good quality companies at these sort of levels."
We've got to talk about stocks as well. We'll do that next. Rick Reader, Mohammed Al-Arian, two of the very, very best sticking with us. In your equity market at the moment, going into the opening bell, futures were much lower. We've bounced back. We're down by about 0.2% with some movers. Here's Abby.
Let's keep it super simple, John, and really take a look at what is being impacted by that hottish jobs report. And with yields backing up really sharply higher, not surprisingly, we have some of the big tech names coming under pressure, puts valuation into the spotlight. The idea that liquidity could be coming out of the system. Amazon down about 0.7%. Alphabet is down more, given its greater than 5% move higher yesterday on enthusiasm for its Gemini product. Take a look at Meta, down 1.3%, really one of the laggards within the underperformance of tech. Probably, John, having to do with the fact that this stock, Meta, up 170% on the year. Investors wanting out of some of those big movers, at least today.
Abby, thank you. More from Abigail around the opening bell. Coming up on this program, President Biden promoting his economic agenda.
All across America, instead of exporting jobs, companies, both foreign and domestic, are creating jobs here in America and exporting American-made products.
We'll get the latest from Capitol Hill following an upside surprise on a payrolls report. Plus, a little bit later, a conversation with PGIM's Mike Collins and iCapital's Anastasia Amoroso.
We've created close to, remember we were told we're not going to be the manufacturing capital of the world. How can we be the manufacturing capital of the world again? Well, we've created close to 800,000 manufacturing jobs, almost twice as many as the previous administration did in all 4 years. The unemployment rate has stayed below 4% for over 20 months in a row, the longest stretch in 50 years. And all across America, instead of exporting jobs, companies, both foreign and domestic, are creating jobs here in America and exporting American-made products.
President Biden touting his track record on job creation last week in Colorado, touring the country to promote his so-called Investing in America agenda. Biden set to speak at 5:45 Eastern Time from Las Vegas before heading to LA for a campaign reception. This as November payrolls come in hotter than expected, with the unemployment rate falling to 3.7%. Joining us from Washington, AMH. Morning, Anne-Marie.
Good morning, John. Well, the 3.7% unemployment rate, as Mike McKee says, that is a stunner, and that is going to be celebrated at the White House. You heard it from the president there. Every single statement for the past 20 months has been, we remain below 4% when it comes to unemployment rate, and I expect him to tout that statistic today. We need to remember, when it comes to politics in this administration, the issue is, as Mark Zandi has put it at Moody's, it is colored by inflation. He says that American families are spending more than $700 a month than they were before the pandemic. So Biden is still dealing with these issues of prices. Our Bloomberg News Morning Consult poll showed that Americans are frustrated and they see more prices are going up and they actually trust the former president, Jonathan, when it comes to the economy. But when you're looking at inflation, and this is the heart of the matter, potentially the timeline could be on the president's side. Already, what are we seeing today? $3.18 per a gallon of gasoline, something that dogged the administration last summer, is starting to come on their side. So potentially their timeline could help them when it comes to the inflation story. But today they have good news to tout when it comes to the jobs picture.
MH, no doubt we'll hear them talk about it in just a moment. Anne-Marie, thank you. Mohammed, another poll, CNN, here it is. More than 4 in 10 saying they're seriously concerned about rising costs, pushing them out of their own communities. Mohammed, talk to us about this disconnect between what they tell us is good about the economic data and what many people in this country still feel.
Yeah, and it must be so frustrating for the White House. Not only is the unemployment rate below 4% yet again, but Jason Furman pointed out this morning that relative to where the CBO thought we would be at this point, we have 2 million more jobs. So there is no question that this economy has created lots of jobs. There's no question that this economy has delivered higher economic growth than most expected and that most other countries have achieved. But as Anne-Marie points out, the problem is inflation. And you have to understand the psyche. For the person in the street, lower inflation means prices come down. In fact, even the White House, as you pointed out last week, got confused on this. It doesn't mean prices go up at a slower rate, which is what it should mean, but in their head, they will not feel that there's been progress on inflation until they see prices come down. Now, they've seen it in gas, but they haven't seen it at the grocery store. And that's why this administration is not getting the credit it deserves for what it's done on the economy.
The administration was taking shots at corporate America for price gouging, all kinds of things, Rick, falling on deaf ears. Let's talk about pricing power, Rick. Right now, in the equity market, where is it?
So pricing power for the for stocks or
for companies, for stocks, and what that ultimately means for the equity market more broadly?
Yep. So listen, I think price elasticity is coming back in some areas. I think in parts of retailing, you look at electronics, furniture, apparel, that I think it's staple, even parts of staples. Like, I think you're running out of room now of increasing prices. You're seeing at restaurants, you're seeing that today, that I think it's really hard to keep increasing increasing prices. And so I think that's really different going forward. And now you're starting to see, and the Fed's talked about this, you're starting to see more promotional. You look at retailing, Walmart's talked about it, Target's talked about it. You see more promotional, more couponing, more less big ticket item. So you're seeing a shift there. Where is there still stickiness? And we talked about this before. Look at insurance. Like, it's pretty incredible. And you see this in all the inflation reports. Look at insurance. Still, they are still raising prices. You look at medical, again, somewhat because of the demographic of where we are in the economy. And then tech. I mean, listen, I think the expenditure on tech, which will keep the economy, CapEx in a good shape, the economy in good shape, is, tech is still very much in demand, particularly in places like AI or software. You look at software stocks. If you can create more efficiency within your business, grow your margins, keep your costs down, people will spend for those types of technologies that create real cost reduction for you. Because I think you've reached a pricing point for your organic product that is hard to raise now.
Gents, before you run, can I get one-word answers from you both? Just pick a month. When's that first cut going to come? Rick?
I was hoping Mohammed would go first. So when is it? So May to July. So somewhere in there. Can I? And it's a funky. So somewhere in the middle, June-ish type of.
Mohammed?
Yeah, I was going to say June, July.
Okay, in the summer, going into the second half. Rick, Mohammed, just two of the very best. Always a privilege, a pleasure. Coming up on this programme, the morning calls, and later, payrolls growing, wages rising. That conversation with PGIM's Michael Collins, iCapital's Anastasia Amoroso. Down a touch. Let's get you some morning calls this morning. Your first one from Deutsche Bank, downgrading KB Home to sell. $46 price target, reflecting the stock's valuation and slowing returns. Morgan Stanley downgrading Qualcomm to equal weight, expecting limited upside as the inventory correction runs its course. And finally, Citi downgrading Deckers to neutral, seeing a more balanced risk reward after recent gains. That stock just about unchanged. Coming up, PGIM's Michael Collins and iCapital's Anastasia Amoroso around the opening bell. Your opening bell is just around the corner. Let's get to the opening bell and get you to the weekend. 20 seconds away from that opening bell this morning. Good morning. Equity futures negative here by 0.2% on the S&P 500. Down on the Nasdaq by 0.5. Looking at that, you would have no idea that on the surface we just had a labour market report that looked pretty decent about 60 minutes ago. We'll get beneath the surface with the administration in just a moment. There's your opening bell. Switch on the board and get to the bond market. Yields shaping up as follows. Higher on the long end on a 10-year by 7 basis points, 4.22. At the front end on a 2-year, yields a little bit higher than that earlier this morning, up by, let's call it 10 basis points to 4.70, 4.69 on a 2-year. That means you get some dollar strength, some euro weakness. The euro against the dollar down 0.5%, 107.40. And in the commodity market, in the 60s early this week, back in the 70s, just about $70.60, up by 1.9% on the session. About 30 seconds into this session right now for the stock market, we're negative 0.2% on the S&P. On the Nasdaq, we're down 0.5. One stock to watch at the open is Lulu. Q4 revenue guidance falling short of estimates. Abby has more. Hey, Abby.
Hey, John. And the stock is showing that disappointment, down 2.9%. Its worst day in about 3 weeks. It was a high bar quarter. This stock into today up about 45%. So investors are expecting a lot. Plus, they typically do deliver. So the quarter that they reported was very solid. But the fourth quarter guide, as you just mentioned, they're looking at growth of 13 to 14%. Last year, it had been 19%. So really missing the mark, or excuse me, the estimate had been 19%. The CFO, in fact, saying that they are being prudent with their planning. That's another way of saying they're being conservative. Some investors could even look at that as this company that typically does put up big numbers and big guidance as sandbagging, and that maybe it's an opportunity for the stock. On the other hand, there are some analysts out there saying that the stock has peaked from a technical perspective. You could make that case on the day right now, putting all of that together, John, down 2.7%.
Abby, thank you. Just erasing some of those losses about a minute or two into the session, we're down by 0.1% on the S&P. On the Nasdaq now down by 0.3%. Some M&A in the industrial space. Honeywell striking a $5 billion deal to buy Carrier Global security business. Alex Semenova has this story. Hey, Alex.
Hey, John. Good morning and happy Friday. This deal by Honeywell International to acquire Carrier Global security business is set to total $5 billion. That's according to a statement from the company. The Wall Street Journal had also reported this earlier. Carrier shares are climbing 6% this morning, and the move by Honeywell is meant to broaden its portfolio of product offerings to include this unit, which makes electronic security locks for large corporations, hospitals, and hotels. It's also part of a move to broaden Honeywell's building automation segment amid a greater demand for cloud-based products. The deal for Carrier's security segment is also part of Honeywell's plans to shell out at least $25 billion over the next 3 years on M&A, capital expenditures, and buybacks. Carrier is expecting proceeds of about $4 billion on this deal, which it will use to pay off its debt. And this move higher bodes well for Carrier, which has had a pretty good run this year. Shares up about 28% year to date. Honeywell, however, down about 7% on the year.
The shares of Carrier up by about 5% on the session. Alex, thank you. Let's get you the update at the moment, 3 minutes in, just a touch lower on the S&P. If you've missed all this, you've missed out in the last hour. Payrolls came in at 199. The estimate was 185. The unemployment rate dropped to 3.7%. The estimate was 3.9. Wage growth month over month, 0.4%. We were looking for 0.3. That is a decent payrolls report on the surface. We can get beneath the surface in just a moment. But that meant you push that through the bond market, yields up big time at the front end by 9 basis points on a 2-year, 4.68. And in the FX market, stronger dollar, weaker euro. A few more acts to play out going into the Federal Reserve decision on Wednesday. We still need to get through CPI the day before, then retail sales later in the week as well. Let's turn back to earnings briefly. RH, formerly known as Restoration Hardware, delivering a disappointing outlook for the holiday season. Simone Foxman on top of this one. Hey, Simone.
Hey, John, yeah, and it was a pretty ugly third quarter for this company as well. They specialize in upscale home furnishings. Revenue down 14% year on year in the quarter. They cut their margin forecast, and this appears to be what analysts are really focusing on for next year, 13.6 to 14%. They had previously seen 14.5 to 15.5%. Barclays, they're one of the few strategists that are actually positive on this name. And they said this was a big negative surprise. So even a big negative surprise from someone that's pretty supportive of the company. One bright spot, we did see losses in terms of earnings per share, but they came in less than anticipated. They were 42 cents. The expectation had been for a loss of 96 cents. Really negative commentary here, too. Interestingly, they pointed out a headwind from the Israel-Hamas war. I don't think we've seen many retailers really point that out. But high mortgage rates, bad for home furnishings. They say the market has become more promotional, real focus on clearance products. And they're going to even delay mailing a source book of modern home furnishings until next year. So pretty disappointing results for them.
Down almost 11%. Simone, thanks for that. Broader market, negative 0.1% on the S&P. Big payrolls report about an hour ago. Let's start that conversation with PGIM's Mike Collins, iCapital's Anastasia Amoroso. Anastasia, you've had an hour and 5 minutes to chew over that. What was that and where did it come from?
Right. Well, my thoughts on this payrolls report is that it certainly doesn't make the Fed want to cut interest rates at this juncture because clearly it exceeded expectations. But I will say it's probably not as hot of a report as maybe it does show up on the surface. And I say that because, first of all, you've got the unemployment rate that did tick lower to 3.7%. But if you look at it, it's still within the uptrend. It has not been linear, but unemployment rate has been creeping higher. But you did have months when it was lower, but it's still amidst this higher trend. And then you look at the payrolls number, 199 on payrolls, is within that same declining trend of payrolls over the last 12 months. So I think the Fed is likely to look at this and say, this is okay. This probably shows some loosening in the labor market, and it's certainly not a very hot report. Having said that, I think the Fed is months away, if not quarters away, from cutting rates, and this report certainly is not going to make them want to do that anytime soon.
Mike Collins, do you agree? Is this worse than it looks?
It is a little bit on the margin, Jonathan. And if you take out the rebound we had from the strikes and the huge increase in healthcare workers, the actual job gains from a cyclical perspective were actually pretty weak. And if you look at the average hourly earnings, which seem on the surface to be strong, again, a lot of that was that manufacturing sector, the higher wages we're getting from the unions. But you look at the services sector, average hourly earnings, it's continuing to moderate, right? So I think, it's the same story. It's a moderating story here. It's a supply side boom that we've gone through, right? I mean, 2 years ago, Jonathan, the demand for labor relative to the supply was 8 times. A year ago, it was 2 times. And now the supply of labor, for the first time since pre-COVID, is outpacing the demand. So I think what's lurking underneath the surface is people are working harder and working longer and taking on more jobs to just maintain the standard of living that they've gotten used to. And that's why we're seeing these big high-end retailers really start to see a pushback.
Yeah, Mike, the story you describe is not a good one. So with all that in mind, Anastasia touched on it. Mike Collins, what do you expect from Chairman Powell on Wednesday?
I think he's going to toe the same line and try to push back on the significant easing of financial conditions, Jonathan, and push back on the 5 rate cuts that are priced in for next year. I do think maybe in the near term, the rally in rates we've seen, the expectations for Fed rate cuts might be a little overdone. But really, when you step back, what's priced in terms of Fed rate cuts, Jonathan, are like a 75% chance that they cut 3 times next year, which is really our base case, but a 25% chance that they cut 275 basis points next year back to their kind of long-term target. And that's what the markets are grappling with. And the first scenario is a good one for markets. That's a soft landing world. The second scenario is a world where the Fed is way too tight and behind, and the whole rate structure goes lower, and probably risk assets sell off in that environment.
So, Anastasia, risk assets so far year to date have been really good. On the Nasdaq 100, up something like 45%. You've been constructive right the way through it for most of this year. Where are you now, Anastasia, on stocks?
Well, I think Mike makes a really good point. What really matters for stocks is why and how quickly does the Fed ultimately cut rates. And if they cut preemptively because inflation has eased and the economy has eased but not slipped into a recession, if they do deliver those rate cuts, then that is a very positive scenario for equities. And we can have sort of a replay of soft landing that we saw in 1995 and the positive returns. Now, on the flip side, if the Fed does fall behind the curve this time on cutting too late and the economy does slip into a recession and or defaults and delinquencies, really sufficiently rise, then that's more of a 2007 scenario. Now, I want to rule that out right now because even though I do think there are pockets of stress in the economy, none of them are systemic, and some investors will take some default risk, but that shouldn't wipe out the whole economy. So I think I'm in the camp that the returns for equities for next year are likely to be mediocre, let's say mid-single digits, unless the Fed really quickly cuts interest rates. And I think you can have a more bullish scenario. So I think equities are worth staying in, for either mid-single digits and higher returns if the Fed delivers.
Anastasia, sticking with us. Anastasia Amoroso alongside the brilliant Michael Collins. We'll continue the conversation. This is what we'll do. We'll reset the price action. In just a moment, we'll catch up with the administration, the acting Labour Secretary, Julie Su. That conversation just around the corner. And then Mike and Anastasia will weigh in on what they heard and where they think this market is going into next year. From New York City on Bloomberg TV and radio, I'm Jonathan Ferro. Pleased to say that joining us now from Washington is Julie Su, the acting U.S. Labour Secretary. Acting Labour Secretary, wonderful to catch up with you. It always is. I want to go back to 8:30, just briefly if we can. I got a lot of feedback at 8:30 Eastern Time about not being able to access the BLS website to get this information, to get this data. I'm told that the message they got on the screen was you are blocked from the BLS website. What was going on at 8:30? What was the difficulty?
I don't know what happened with the website. I will say that our jobs numbers today show that 199,000 jobs were added last month that we have the lowest unemployment rate for the longest period of time since Diana Ross was at the top of the charts. And it reflects continued steady growth in our economy. I'm sorry to hear that you weren't able to get that, but I'm happy to talk about any of the data that's come out.
Well, let's talk about it coming out next month, and the month after that, and the month after that. Can we revisit the lockup, Julie, and have a lockup and make sure this data gets out efficiently and effectively, given it's probably the most important data point on the planet?
I completely agree on the importance of the data. We come out to talk about it every time because it demonstrates the health of the economy. It demonstrates, whether our economic policies are working. And what we've seen is steadily, since President Biden came into office, 14.1 million jobs created, again, broad-based across numerous sectors, low unemployment rates, and real wages rising. So we are very happy to make sure that you are getting the information that you need to help us tell the story about the impact of Bidenomics across the country.
You really don't want to talk about this, do you?
No, I'm not trying to avoid it. I obviously believe that the data has to be available.
But it's not.
To all of you.
And it wasn't. So how can we fix that for next month?
I hear you on that.
OK, maybe you can respond to me in the future at some point in the next week or so, and I can share that answer to our listeners and our viewers. Let's talk about the data. On the surface, it looks great. This is from Capital Economics this morning. The response from them this morning, just going beneath the surface, respectable organisation saying this: the 199 increase in November payroll employment included 47,000 workers returning from strikes. Stripping out that one-off boost, the 152 gain was roughly the same as the muted increase in October. Moreover, of that 152, 49,000 were government jobs, a further 77k in healthcare. Excluding those non-cyclical sectors, the economy added only 26,000 jobs, which adds to the evidence that after a very strong third quarter, growth is slowing to a crawl in the fourth quarter. Julie, what would you make of that?
I think what we're seeing is, again, we look at overall trends in the economy. We've seen job growth at record rates, certainly faster than anybody predicted coming out of the pandemic. But it wasn't just like, one-time boost in the immediate post-pandemic months. It's been year-over-year growth. We're also seeing it across numerous industries, and we're seeing it in, overall, right? Over 800,000 jobs created in construction, over 600,000 in manufacturing since President Biden came into office. And yes, we also saw workers come back on the payroll after strikes that resulted in record wage increases and other kinds of benefits, retirement benefits, health benefits that we really associate with what we want for working people, right? It's what gives families a sense of security. It's what gives individuals what the president always talks about, which is some breathing room. And that's the kind of economy that we want to build, that we are seeing. We have more work to do, and we'll continue to build on the progress that we've made. Many of the investments that the president has helped to make possible are showing up in communities, 40,000 some infrastructure projects across 4,500 communities all across the country. But we're just beginning with that. And so we'll continue to see more of that. And the jobs numbers are just another, indicator of that growth and what its impact means.
Why do you think this is not resonating with the electorate? I'll share some polls. CNN, more than 4 in 10 saying they're seriously concerned rising costs could push them out of their own communities. Bloomberg, together with Morning Consult, only 35% of voters in 7 swing states trust Biden on the economy. Where's that disconnect coming from?
Right. So one thing President Biden does talk a lot about, to your point, is we want to make sure that there are jobs in communities so people can get jobs and build a family and join the middle class without leaving the place that they work, that they live. I was with him when we went to Belvedere, Illinois, where a plant that had been shuttered is now being reopened because of the agreement between the UAW and the Big Three. I do think some of this is still, we had global, pandemic and the economic wreckage that resulted immediately in the aftermath of that. Again, we've grown back from it, but the sense of insecurity, I think, remains, and that's legitimate. The other thing, just from traveling around the country and talking to folks, is I think that part of this is that people really do see there's jobs being created, there's training programs that are connecting them to those jobs, but there remains deep inequities in our society, and part of that is the huge gap between CEO pay and frontline worker pay. So I talked about Diana Ross. I talked about the good news that we are having unemployment levels at record lows for the longest stretches since 1970. In 1970, the disparity between CEO pay and frontline pay was something like 20%. Today, it's over, it was like 17 times higher, the CEO pay from worker pay. Today, it's something like 344 times. That doesn't feel fair to people. It doesn't feel good. And that's why President Biden talks about building an economy from the middle out and the bottom up, where working people and working families do well, not just the wealthy.
Yeah, he's had a lot to say about corporate America as well. I'm going to share a tweet from the president with you, and I want your thoughts on it. I want you to translate it if you can, because I don't understand it. It says, "Let me be clear to any corporation that hasn't brought their prices back down, even as inflation has come down. It's time to stop the price gouging, give American consumers a break." What is the president talking about?
The president is saying that we have a job to do in this country, and we want working people and middle-class families and every community across the country to have the things that they need to live a decent life. We want safe roads and new bridges. We want clean drinking water to flow out of every faucet.
Yeah, again, that's great. I want that too, but just this
internet.
tweet specifically. Inflation is slowing, but it's still positive, so prices are going up. But the president's saying inflation has come down. Why are corporations still price gouging? That's just, economically speaking, just absolutely flawed. So Acting Labour Secretary, who writes these tweets, what's he talking about?
I mean, he's saying that we're all in this together, and we will pursue economic policies that help to bring down prices and control inflation, but everyone's got a job to do on that. And we, when there are record profits by companies who are continuing to keep prices high, we'd like them to play their role in making sure that people can afford the basics they need in life.
Appreciate it. Judy Sue, thank you. The Acting US Labour Secretary. Anastasia Amoroso, Mike Collins back with us for more on this. Anastasia, big disconnect between the administration at the surface and what's happening beneath the surface and how people feel. Anastasia, what explains that from your standpoint?
Yeah, I mean, I think one of the points that Julie did talk about, which is the income inequality. I mean, there are definitely stats out there that show that the top 20%, for example, today, the gap between the top 20% income and the bottom 20% income, she's correct, has grown quite significantly since 1975. So I think that does explain some of the insecurity or some of the lack of economic insecurity sentiment that is out there. I think that's one thing. The other interesting point that I thought she made was on the infrastructure side. And that is right, that the infrastructure stimulus that has been passed now several years ago is still working its way through the system. So I think when we wonder, why is the labor market continuing to be so resilient? Why is the economy continuing to be so strong? It's because all that, backward-looking fiscal stimulus is still working its way through the economy.
Mike Collins, your take?
Yeah, I mean, obviously, Jonathan, to your point, jawboning companies to lower prices is not going to work. What will work is consumers pushing back on the elevated prices. I was looking at an index of food prices this morning, Jonathan. Food prices are actually down globally 25% from their peak a year and a half ago, right? So to us and to Wall Street and to the Fed, that's disinflation, but they're still up about 10% annualized since the pandemic. And that's what people are feeling, right? Those are the prices that they're really struggling with to afford. And it's not just food, right? It's across the board. So Biden can do all the jawboning he wants, but what's going to get prices to come down is weaker consumer demand. High prices themselves will obviously cause more disinflation. So I think we're on the right path. I mean, disinflation is happening. It's happening slowly, but it's moving in the right direction just because of macroeconomics and supply and demand.
Mike Collins, Anastasia Amoroso, to the two of you, thank you. About 23 minutes into the session, equities just about unchanged on the S&P. Your trading diary up next. 26 minutes into the session, just about unchanged on the S&P 500. Here's the trading diary, what you need to be looking for going into the weekend and into next week. Tuesday, the latest US CPI report. Wednesday, PPI numbers just around the corner. Then the big one, Fed Chair Jay Powell at a news conference off the back of their decision. Thursday, the ECB's turn, along with the Bank of England. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV, and have a wonderful weekend. This is Bloomberg.